Still focused on the economy. I've got an associate professor of finance with the Nasarawa State University. He's also the head of the head of banking and finance department at the Nasarawa State University, Uche Owaleke. Good morning to you, and thank you for joining me on the program.
Yeah, good morning, Harriet, and thanks for inviting me.
Right, so let's start off this conversation. So much has already been said about this, but taking a look at this drop, and it's already been attributed to the base effect. So as at February last year, we had a lot of issues that came in with regards in the energy sector, and so that kind of affected core inflation and caused the headline inflation to rise. So would you say, or would you agree that this is an indication that the economy is recovering maybe? Is it something to celebrate?
Well, it's something to cheer about, no doubt. Coming for the first time in 15 months, inflation rate dropping by 0.94% from a high of 18.72 in January to 17.78 now, year on year. But it's not yet time to roll out the drums, and that's because on a month-on-month basis, we hear it actually increased by 1.49%. And again, taking into cognizance the fact that only in January last year, this headline inflation rate was as low as 9.6%. And today we are talking about double-digit rates that are a little shy of 20%. So it's not yet time to roll out the drums. Again, if you take into cognizance the fact that even within the federal government's 4-year plan period, talking about the just released economic recovery and growth plan, the government projects that by 2020, the inflation rate would just be 9.9%. Again, higher than what it was only in January last year at 9.6%. So that tells you that it's not going to be easy, subduing inflation, going forward over the plan period. For me, too, what came as a surprise was the fact that the food component again rose by as high as 18%. Okay, the National Bureau of Statistics attributes that partly to the rise recorded in commodities like milk, like fish, meat, bread. And of course, bread, there's the wheat component. And these are items that are largely imported, into this country. And many of these items fall within the 41 items that are currently being restricted from accessing the forex from the official window. So that tells you that the pass-on effect of the high exchange rate is still being felt, on commodities. But as I said earlier on, it's good that this has dropped to 17.78%, and I think that the headline inflation will keep ticking downwards as we move forward, especially now that we are beginning to have improved liquidity in the forex market, following CBN's persistent intervention in the forex market.
Dr. So Owaleke, let me come in here, Dr. Owaleke, and I'm going to
pass on effect to moderate inflationary pressure. Yes.
Let me come in here. Sorry to interrupt you there. Let me start from the bottom part of what you've just said. Now, talking about the fact that food inflation remains pressured, and we saw that increasing at a faster pace to 18.53%. But then again, it still begs the question, why can't we still ramp up domestic food production? The federal government has consistently talked about having silos to try to encourage these farmers who can't sell off most of their produce to store them, just to ensure that we don't get into a crisis situation. At the beginning of the year, that was one of the major headlines that we saw, that Nigeria might be heading for a possible famine. And so this has again brought up the issue of what the federal government needs to be doing at this time to stave off a possible famine.
Yes, of course, agriculture contributes about 23% of GDP, and the bulk of that is made up of crop production, which is why you find government policies targeting crops, essentially. Even the central bank too has also been complementing the federal government's efforts in the area of intervening, especially in rice production. I'm sure you're aware of the Anchor Borrowers Program that has led to at least an increase in the production of rice. And the Anchor Borrowers Program too has also gone a long way in filling the huge supply gap of close to 4 million metric tons that we have in rice production. But there are also other areas you would expect the government to come in. Recently, we read about the case of cassava. Cassava production dropping because farmers felt that there was glut, in last year. So glut brought down prices, and so they were not encouraged to go into production. So that is where the issue of silos, becomes very, very important. And I think government should look into those. Now, if you look at the Economic Recovery and Growth Plan, government has made some projections there. And fortunately, some of them too have targets attached to them. Take the case of tomato, for example. Government says it intends to achieve self-sufficiency in tomato paste production by the end of this year. That originally was put at end of 2016. If you look at the 2016 strategic implementation plan, it was at 2016 initially, but has now been shifted to 2017. Rice, government intends to achieve self-sufficiency in rice production by 2018, wheat by 2019. So we need focused policies to bring that about. And that's why I'm happy that the central bank is also complementing by targeting some of these critical products that consume a lot of our forex. So I feel that as we continue to have experience accretion in our reserves, following favorable international developments in international oil market, as we continue to have improved liquidity in the forex market, inflation rates will continue to come down, and possibly it's very possible for the government to achieve the 15.74% target it has set for itself in the 2017 with regard to headline inflation.
Well then, Dr. Owaleke, some policy analysts say the country is now moving towards the real inflation measurement, in spite of the spike that we've seen in food prices and despite the drop we've seen in core inflation as well as urban and the rural indices. Do you agree with this?
Yes. Of course, the reduction we have had, the National Bureau of Statistics attributes that partly to the base effect. The fact that this time last year, non-core, or rather the core inflation component was already high. Electricity, for example, was high. So given that base effect, we've had this reduction. So that tells you that the reduction is not particularly real. So going forward, therefore, we expect that the government should identify these critical factors that drive inflationary pressure in Nigeria, as already identified by the National Bureau of Statistics. If you look at the core aspect, for example, electricity, housing, fuel, transport. So these ones are key. And therefore, the government should focus on ensuring that we have the infrastructural deficit, is tackled to be able to bring down this the core inflation. Also on the food index, even though you might say the food index, because of the volatile nature of agri products, the CBN doesn't really bother much about the food components. The central banks all over the world bother more about core inflation than food inflation. So monetary and fiscal policies should be aligned to ensure that headline inflation comes down. The Monetary Policy Committee of the Central Bank will be meeting any moment from now. So I don't expect that, of course, they're going to, because the food inflation has increased, I don't expect them to increase the benchmark interest rate from the current 14%. Okay, at worst, it should be left the way it is. Some of us have always argued that because we are still in a recession, even though the recession is easing, there is need for the central bank to, drop the benchmark interest rate, or to pursue, if you like, an accommodative monetary policy. But it's still early to say that, which is why I would expect them to hold the rates when they meet sometime this month.
But then, given the way it seems the economy is gaining traction, both from the fiscal and the monetary side, everybody coming to the table trying to make things work, and then looking at this data, or various data that continues to come out from the National Bureau of Statistics, who, by the way, are doing a very remarkable job in terms of providing the needed data, what's your immediate and maybe medium-term outlook on the economy going forward?
Yes, I want to align myself with those who have predicted that this economy is going to come out of a recession this year. Even if we use the economic recovery and growth plan projections, that the economy is likely to grow by 2.19% in 2017, and in 2018 move up to 4.8%. 2019, because of the effect of the election year, maybe drop again to 4.5%, and then by 2017, rise to 7%, which is the one I consider a little ambitious. But I strongly believe, yes, the economy is gaining traction. Of course, we've seen the last quarter, 2016, result at 1.3%, 1.3% contraction. A lot better than what we saw during the third quarter of 2016, which was as high as 2.24%. So it's no doubt it is easy. And of course, for 2016 overall, the economy contracted by 1.54%. So we are beginning to see traction, no doubt. And if you also look at some of the figures we've been getting with regard to Purchasing Managers Index, even though we have getting conflicting figures from various research agencies, but the one from the central bank also speak of an improvement in Purchasing Managers Index. So if we have improvements in the GDP figure, we have improvements in inflation rate figure, we have improvements in the major macroeconomic indicators, I strongly believe that the economy will be will get out of recession in 2017.
Dr. Uche Uwaleke, Associate Professor of Finance and Head of Banking and Finance Department at the Nasarawa State University. Many thanks for joining us on the program and sharing your thoughts with us.